Look, investing on the stock market, it ain't flashy, but it could help you make some money just by flipping around on your phone. How's it going, guys? Kevin here with Entertaining Entropy. You look fantastic today. I'm putting out a video on options trading with Robinhood is the app that I'm really using. You could trade with a lot of other apps, but this one is the one that I find to be the most clear, easy for new users to get into, zero fees too, doesn't hurt at all. I always talk about interesting stuff on my channel, week to week, putting out new videos. If you like what you see, if you want to see more, subscribe, comment to give me some ideas on stuff you want me to talk about, dive into more stuff that I've already talked about, or get some more information, get questions answered and things like that. Going over today's topic, I will be actually covering options trading, again with Robinhood. This is going to be using spreads. I'm going to be trading with SPY, the S&P 500, an ETF that is really one of the best ones to focus on if you're looking for upward bullish trends. We're also going to be looking at NAK. I'm looking at some other stocks here that I've been leveraging, IGC, and some others that I found to be really good for this type of strategy. There's a lot of different ways that you can leverage these. I am not a financial advisor. This is non-financial advice in case anyone was confused. But this is just trying to empower people that are interested to make a little bit of passive income, learn a little bit. Kind of ends up being like a game for me because I'm just trying to win, get more money, and try to lose less. When you're putting things into this, make sure that you're not putting in any more than you can afford to lose, because it is really a gamble. It's a bet. But where I try to make it easy with my options trading and with the strategies that I use, I'm going to try to leverage different ideas and processes to try to minimize risk and make it easy for you guys to make a little bit of money quickly. And again, if you like something that you see here, if you find it confusing, leave me some questions. Before you watch this video, it may make sense to go back and watch my options 101 trading. I tried to break it down step by step to give you just a baseline foundation. It may not be interesting, but it does give you that foundational supportive information to get you started here. So, love what we're getting into. Let's get started and hope you like what you see. So today, just overviewing some of the topics that I'll be covering. I'm just going to use the S&P 500 as an example here that you can see on your screen. We're going to be overviewing selling options, buying options, running something called a wheel. I'm also going to be going into credit spreads, which is something that I can make money on using the S&P 500, which is a stock that I expect will go up. As you can see here on your screen, it's going to always keep going up. This is what it's kind of designed to do. And I'm also going to be talking about calendar spreads as well. So just kind of giving a quick overview using the S&P 500 on those topics, and then I'll dive a little bit more into what they look like using other specific options chains and other stocks. So initially just wanted to start about buying and selling calls and puts and what that means, just to give a baseline for anybody who may have spent some time before they've watched my previous video, or maybe they're new to this. Though I do highly recommend watching that first video before getting into this because it's a little complicated. Initially, buying a call is meaning I'm expecting the price to go up. So if I bought this 468 call for $349 and it says 348, but this is times 100 because you buy it in parts of 100. This $348 that I had here is going to bet that the price is going to go up, and this would become more valuable. The price of this would become, maybe $400 if the stock price rockets above 468, and then I would sell it for the 400 and make $50. If I'm looking at buying a put, this is where I'm guessing that the stock price is going to go down. So if I have some event that I think is going to cataclysmically affect the stock here, again, it's a cost because of buying. In this case, it's a similar price, and I'm expecting the price of the stock to go down. So if it goes below 468 here, this is going to cause this contract, the value of this contract, to go up, and thereby I can sell it and make some money on that. And the inverse, if I'm selling these options, I'm actually making a premium. You'll see when I do the same thing selling, I get a credit. So I'm actually making $351. In this case, selling a call inverses it, so we're expecting the price to go down or stay down, really. And if I'm selling a put, again, I get a credit, but I'm actually expecting the price to go up. And in this case, it's a little bit of a funny situation because you need 100 shares to be able to sell positions as you're holding collateral to be able to do that. The other thing that I'll be talking about is debit and credit spreads, which is when you combine these. So I can take a put and I can buy one here, or excuse me, I can sell one here and I can buy one. And this turns it into a credit spread where I'm basically opening up a position that I hold $100 but it's going to hold $100 collateral, but give me initially $30 of credit. And this is betting because it's a put that the money was, that the stock price would stay above this price. And I keep my money. If it does, I could go the opposite and do a put debit spread and bet that the money would go down, that the stock price would go down. You can do this with a call as well, and it would just be all the inverse options. Combining these, I can do something called an iron condor. So sort of above and below the stock price, I buy and sell a call, and below the stock price here, I buy and sell a put. And this turns it into an iron condor, which is essentially making it so that if the share price stays between that, I'm actually making money because it's not jumping up and going down. So a lot of ways that you can actually make money with the options here. Some of these are more predictable than others. The S&P 500 tends to go up, although it's very affected by large events like the different viruses that have been coming out and news events that hit the market. So showing off how I will actually use these types of things, the S&P 500 isn't a great way to run the wheel because it takes a lot of capital to be able to do that at $467 per share. But I do use an option called, a stock called NAC to be able to actually trade these types of things because it's worth right now 36 cents. And when you're trading options contracts, you're using 100 shares at a time. So this is something that's going to make it really easy at 36 bucks just to open a position. So initially what you're able to do when you're trading NAC options is you start by opening the wheel, selling a put. And when you're running the wheel, you're always going to be selling options. So here, the lowest I can do is sell at 50 cents, which means I'm kind of like getting into the position thinking that either it's going to go up and above 50 cents and I'll keep my premium and just roll the dice again, or I'm getting into it where I'm pretty much making exactly the same amount, 13 bucks where, is the difference between 50 cents and the 37 cents or so that it is now, give or take $1. So what that does is it kind of preloads me onto this position. If this share price stays below 50 cents by, in this case, December 17th, I would be forced to pay $50 to buy 100 shares of this particular stock. Because it's 37 cents, I immediately lose $14, but that's the $13 credit kind of offsets that for you so you can get into that position. When I'm there with those 100 shares, then I'll just flip my position to sell calls. It's, you could push this out to whatever date makes sense, but here I have a bunch of shares available that I can do this. And in this case, because it's so close, obviously nobody's going to take it, but anytime you kind of push it out, you get more and more money. And in this case, I'm making 10% already here on this particular item where it's actually going to be giving me $5 right at the gates for selling a call. And selling a call represents that I have 100 shares on this particular stock, and I'm willing to bet that it's going to stay below 50 cents up until, in this case, February 18, 2012. Because I'm doing this, I'm keeping my premium if it stays below that, but I'm also selling all my shares and getting my collateral, getting my money, whatever you want to think of it, back if it does go above 50 cents. If you're using the strategy that I just described, that 50 cents is how you got into the wheel, so you make a net zero, and you would have kept that original 13, 14 bucks that we started when you sell the first leg of this. This is also another stock, IGC, that works really well with this too. This is one that I found I've made actually a lot of money. Right now it's actually down to, looks like 123. So it ends up being a really good stock to sell options on. And with this too, you can see again, say it's 124. Do I think it's going to keep going down? Let me go ahead and sell a put at $1 here. Obviously, nobody thinks it's going to go down to that by that fast. But look, I can get $8 already by January 21st. Somebody will give me $8. And if it does go down to $1, the share price, it means I'm really just buying 100 shares at $1. So really, if it's around or below $1, I'm not really out that much money, and I'm keeping this $8 credit right out of the gates. Once it does that, and if I do end up with these shares, I flip my position. I go here and start selling calls. As you can see, I could put it right back at $1, or I could put it up at $1.50. Maybe I bought 100 shares for $1. Selling it at $1.50 here will give me another $10 credit, and I make the 50 bucks here for the difference between $1 and $1.50 on that 100 shares at 50 cents each extra. So it really does end up putting money in your pocket pretty quickly. And you can see Robinhood actually adds a bunch of graphs here to show you your expected profit and loss. It gives you a little bit of estimations on how much they think that's actually going to work. So this ends up being really my favorite position to run, and the favorite thing that I like to leverage. But in addition to this, you can also say, well, I'd like to do that against the S&P 500 because I know it's always going to go up. So how do I make it so that I can have the amount of capital to be able to do that? And that's really where we get into those debit and credit spreads, because I know that the S&P 500 is going to continue to go up. I can sell a put credit spread. And again, I'm going to do this kind of below the money here to be safe. But we can call it, say I get $9 here at 449. I'll back this up by buying a put here just below it. I'm still going to get my credit. In this case, it's only $1 because it's not that risky. But as you kind of imagine, I could spit this out to, December 15th and do the same thing. Going down, selling a put here, let's call it, we're never going to get down to 434, I don't think, and we'll say we'll buy something right below that. Here's some more money for me. In this case, I'm actually sort of picking up pennies in front of a steamroller because I'm being really safe here. But as you get closer and closer to the money, you can get more and more credit, more and more risk, offers more and more reward for these types of positions. So again, kind of getting closer here. Let's show an example. This is on a live market here. I don't think that the price is going to drop any more than $8 here. And I'm over at December 15th, which really isn't that far away. I can get 34 bucks right here for my $100 risk right in my pocket out of the gate. So doing this a couple times, you can very quickly outpace your $100 collateral and be in the money and just really be making profit at that point. And if you lose out, you're just setting yourself back and not actually losing anything. SPY offers a lot of different positions here, where most options positions, chains, and options on stocks are not really going to offer this many dates. This really has a lot of things for you to build these types of predictions and these types of guesses out. So it really helps to show the types of things that you can do with options. Alrighty, so for my last thing that I'll be going over today is going to be something called calendar spreads. I'm going to use the SPY S&P 500 here as the example of where I'm leveraging this type of process and this type of strategy. The idea here is to grab something. I'm going to use a put spread, calendar spread here. And the idea with the put spread is that the price will be above the stock price, or the strike price, I should say, that I choose. If I went with a call, this stock price would have to be below the strike price that I choose. So by buying a put, the idea is to go really far out. And initially it's a cost, but eventually I pay off the cost and then start making money on that position. So here we'll just grab the first position in 2023, just as this example. And since the price is here at 468, I'm going to bet that, it's really not going to get below 460, let's say. Kind of a risky bet here. I could really go a little bit further down to take a little bit more into this. But this is only going to cost me $38 to open this up. And I'm going to sell the other side of this at an option date that's actually a lot closer to me. Let's go for even, let's say, January here. And these $38, and we'll find the 460 would offset with the premium that I get from opening this position. Selling a put gives me a credit. So you can see here, it brings away already $7.79. And as I continue to sell these positions getting closer to that date, the idea is to offset and to overpower the initial $30 here investment. Because by the time it hits January 14th, I can then open up another position before that 2023 date, and another position and another position. Again, the idea is to offset this initial cost and make premiums. The S&P 500 is something that's designed to go up, so this is a good place to do this type of strategy. But other stocks might be, good for this as well. And you might want to do the call side of this instead, flipping and saying that the stock is going to stay below the strike price that you've chosen. Look, investing on the stock market, it ain't flashy, but it could help you make some money just by flipping around on your phone. That's kind of cool. If you like what you saw in today's episode, leave me some comments, leave me some questions, but make sure to subscribe for weekly updates on every video that I'll be releasing: cryptocurrencies, technology, trading, NFTs. If you wanted something else, let me know. Good luck investing. Have a great day.